Give it a couple more seconds here. All right. Hello, and thanks for joining us. I'm Cory Walters, an associate professor in the Department of Agricultural Economics here at the University of Nebraska. As part of our centered webinar series, these live sessions are typically held every Thursday at noon Central Time, and you can always find an updated schedule, registrations, and an archive of all our past webinars at our website at cap.unl.edu. In this webinar on crop insurance, we will discuss projected prices for the 2024 crop year, the role of insurance in managing risk exposure, and what different contract options can and cannot do for 2024. I'm very happy to be joined today by Ken Harrison, who is a lifelong participant in the crop insurance industry. If you want to, he knows everything about insurance. Beginning as a farm kid in high school, Ken worked as a crop insurance agent, moving into an AIP, 5-state territory management, and then to Kansas City for 40 years, working in crop insurance in development and education. Ken, thanks for joining me.
Pleasure to be here, Cory. Looking forward to it.
All right, let's jump into this. Let's get right to the prices that are going to be coming out. Do you see that, Ken?
Yes.
That's okay, Ryan? Okay.
That looks good.
Okay. I thought it ended. 2024 projected prices will be coming in somewhere around 466 a bushel for corn with a 0.19 volatility factor. And I'll touch a little bit here on the volatility factor in a few slides. As we have here, we have graphed the December prices during the month of February against how that average is, and they came out pretty close here. We're currently trading somewhere around 461 with an average price of 466. So that is good, meaning we're close to that a good small differential between the projected price and where futures are actually at right now. For soybeans, similar story. Also, we're under where the prices are at right now on futures compared to that projected price of 11.56. Give me a penny or two since they're not quite finalized yet, and a volatility factor of 0.15. Crop insurance is complicated, so are our lives, but there are ways to simplify reality and think about how to use insurance to your benefit and incorporate it into your farm. But to do that, we have to understand what's around us and how we influence it and how our surroundings influence us. First one is risk is personal. We have to use our own information when making decisions. That includes things such as cost production, your insurance contract through your own guarantee. You have to know what your coverage level is, whether you have a high or low deductible. You have to know your insurance type, whether you have a revenue protection, yield protection, exclusion, maybe you're up at a county level policy. You have to know your unit structure, whether you're across all acres on a farm of a crop is insured as one insurable unit, such as enterprise, or you're down there at optional, where every section's a different vehicle of insurance, or even at basic. You also have to be aware of what's happening around you. The adage is here, just because it hasn't happened to you doesn't mean it won't. Think of something like a derecho. It happened maybe 50 miles away, 100 miles away. Does that mean you have exposure to that as well? And very importantly, risk is by definition rare, and it is financially devastating. So I don't expect to have risky things happen to me, but I want to know whether I'm financially exposed to them or not. I don't think about them as they're going to happen, but I want to know whether they're in my set of outcomes or not. I want to peel them off. Looking forward and own your own decisions. So we're not going to look backwards today. We're going to look to 2024. We're going to be on our own new unique year going into 2024. Trade the market you're in, not the one we want. We don't have those prices from 6, 8, 10, 12 months ago. We have the prices we have today. We have to manage today's prices. I also, and no one else can, tell you what's going to happen this upcoming year. The only thing I can manage about this upcoming year is the distribution of outcomes that I'm exposed to. Again, I want to get rid of rare financially devastating events out of my portfolio. Agriculture will continue to require more and more financial knowledge to operate. It is very much a financial setting of a lot of complications. Keep learning, keep improving yourself, because it's going to get more complicated. Going to give you a thought here to the state of nature of crop insurance and what it can do when you start thinking deeper about what's going on in insurance, what it's offering you, and your own conditions. And I'm going to give you one in lentils because it's a crop not grown in Nebraska, because I want you to think about where you're at for corn and soybeans, whether it's irrigated or not, whether you're in the east side of the state or the west side of the state. But here's a cost producing lentils. It's a solid cost of $250 an acre. And the crop insurance guarantee, less premium, is guaranteeing $360 an acre. This is literally the world we live in, and every year it changes. So there's profits there, for sure. But those economics are going to change from year to year. Think of this year, I suspect there's going to be a lot of acres of lentils being planted, because other people are going to realize the same thing, other growers of lentils. And they're going to plant lentils, and the market price is going to drop. So what's going to happen? Very likely to happen. Pretty good chance that prices will drop, because acreage is going to produce something out of the acreage, and prices will drop by fall. Now, it's not guaranteed, but there's a chance that there could be a drought over a large growing region of lentils, and prices could continue to go up. So what do you do in this case? Well, it looks like it's pretty advantageous to buy insurance, because you're guaranteed a profit. Insurance is changing the game. We're 24 years into it now from the last major subsidy change in premium subsidies. And we have to understand deeply about what insurance is doing to us. You have to integrate it into your own operation. At the very basic level, insurance rearranges financial outcomes. I'm going to give you a graph of that here. You have two choices. Let's say you buy insurance or you don't buy insurance. And the numbers at the bottom are dollars per acre here. And the idea is straightforward. Insurance just lops off the bad outcomes, low yields, low prices. That's a place I would rather be drawing out of, is the insurance distribution here, and not the no insurance distribution where I have to be financially responsible for those losses. And then as you keep repeating every year, certain costs around the farm will change, because we know we're playing in this game. And this is where we have to understand insurance to use it strategically to improve farm financial performance. Because if you're going to be low on insurance, or not have it, or go to the self-insurance, that's the no insurance, then you'll have a different path financially moving forward. And that could be good or it could be bad. But to do this, to understand what this distribution, the power of this sampling out of this distribution here, you have to know how insurance works. You have to understand how markets work. Remember, we're linking them now. And you clearly have to understand your costs. What is the most successful risk management strategy? Those that survive time. Time is not last year. I hear this way too much. Well, I bought this insurance product last year and it didn't pay out. Okay. What does that mean? If I'm here, there's a whole bunch of outcomes in here where I'm just paying premium. I'm happy for that, because I know I don't have this tail to contend with anymore. I can take that money that I used to have down there for bad things, and I can put that in positions that will help me even further my farm's performance. One bad event can put you on a path to ruin, because it can start sinking the ship, because then everything else starts unraveling. So I'm asking you to think deeply about insurance through time, not last year. It's not last year or the year before. It's over time, long run. What do these insurance prices mean? So let's go through that. So this is the probability distribution of where December prices could end up this fall. So where we will be by this fall. So the idea here is the price, the 466 for corn, gives us the price, and the volatility gives us the range around that price. So I am worried then about, for corn, for ending up down here. And we got $3 a bushel here. So there's a chance of going sub $3 come fall. Do I want to be exposed to that? Do you want to be exposed to that? I'm not saying it's going to happen, but there's a chance. Okay. I want to get rid of that. This is the exact same thing, except in cumulative distribution form. We can go along here at a 5% chance. That's the blue line right here. That's a fairly rare, but not too bad, a 1 in 20. And that price, once you hit that S curve, goes down, it puts you about $3.40 a bushel. So there's a 5% chance. Okay, so a reasonable chance. I want to get rid of that out of my distribution because I want to make sure I can survive in the future so I can get back to high price years. There'll be coming some high price years. So you have to ask yourself, which place would you rather, which world would you rather operate in? The insurance world or the no insurance? And again, this is not about being right or wrong in insurance. This is about having a long run strategy about what distribution do you want to sample out of? The one with the tail lopped off or not? So this is simply profit at the bottom down here. This is actually for this upcoming year for a hypothetical farm here in Nebraska. And if you see, zero is right here. So insurance is right around just cutting you a little teeny bit of profit after costs. Okay. But I want you to go through your own on your own farm. And you may find that you have a negative number. Maybe your costs are a little higher or your APH is a little lower. And if you have a negative number, you have a little bit of exposure and you need working capital to cover that if it happens. Again, it's low chance, but you need that working capital there. So you're managing all of these things simultaneously. Talked about markets a little bit ago. I'm going to go a little further into markets and give you some insights. This is the price path of many years from March 1, we're essentially there today, to the fall, over here to harvest. And this year's 2024's price path futures is going to evolve randomly, just like these have here. We could end up with a lower price or a higher price than we started with. Can't tell you. Maybe there'll be a spike somewhere here in the middle. Maybe there'll be a low spot. But what I can tell you is that over the past 35 years, corn prices from March 1 to the fall have typically peaked right around the end of June. I guess June got cut off here, so the end of June. And they've ended up lower in the fall, more years than not. Okay, so we're at a discount there. And you're going to see why I'm highlighting this over here. So it's important in thinking of expected income right now at the beginning of the year. Same thing for soybeans, except the ending price is just slightly lower over time over the past 35 years since from the beginning of March 1 over here. And the max is somewhere around mid-May to mid-July is where it usually peaks, somewhere in here if you're playing the seasonality game, right? Every year will be different, but if you keep repeating that strategy over and over again, you should converge to something like this. Of course, I don't know what the next 10 years will bring us, but this is the information we have. We only have historical price paths. Forward-looking and personal. So I don't know what will happen this upcoming year, but I can tell you that historically, we do have between prices are on the vertical axis, and yields, we have a negative correlation. And this is for Colfax County. This is the personal part. That's a negative deviation. So when you have low yields or high yields, usually have a low price. And then when your yields start dropping off, then prices start going up. Okay, otherwise known as the natural hedge. So let's get into markets, insurance, and a budget prediction. So this time of year and throughout the winter, farmers and lenders want to predict what's the most likely outcome this fall. If you take a back of the envelope calculation, we were calculating somewhere around a $77 per acre profit. This is in corn, non-irrigated, and you add in the seasonal, the profit actually drops to $33 an acre. Why is that? Well, it's this guy right here. Over time, prices are lower in the fall than now. So we're taking like 20 cents off for that to occur at the expectation. All right. And we add in the correlation to the seasonal, and price continues to drop. Profit, continues to drop a little bit more. We find that this is quite a bit more accurate because those market conditions, those traders in those markets, we're imposing that then on the profit. Okay. Couple discussion points before I turn it over to Ken. Trade the market you're facing, not the one you want. Insurance provides you a revenue floor. Use this to your advantage on everything around the farm. Identify your exposure by identifying if your costs are higher or lower than your guarantee. Can you handle this exposure? And understand how you're going to change that exposure when you're increasing or decreasing your production costs. Expected income can be misleading, and it appears to be on the high side. I suggest focusing on exposure, keeping that as small as possible, and enjoy profits when they come, because there's a large side of that revenue distribution that's going to get you a lot of money. Ken, this is where I'll turn it over to you, and I will forward the slides for you.
Thank you, Dr. Waller. I think Dr. Waller laid out a terrific story about the situation that we're in this year. And the question comes up, how are we going to manage that? And like he mentioned, the first thing we need to do is we need to know our own risk. And what I'd like to do is just sort of back up a little bit, talk about risk in general for the farm. And the general knowledge around the ag community are that there's 6 areas of risk: production. Let's jump down to marketing. I think Dr. Walter's pretty well covered that. Let's back up, if you would. There you go. Marketing, the second bullet point. This is what Dr. Walter explained about changes in supply and demand fundamentals and fluctuation of input and output prices. You need to manage that so that you've got profit in mind. But the key to making that all work is up to the top bullet point of production, because nothing happens until you get yield, unless you got insurance where you're guaranteed a yield. And talking about your environment that's wrapped around you, the weather, the climate change, pests, diseases, technology, and input quality. Quality seed, quality chemicals, and that type of information. And that, one of the things like Nebraska, I've been fascinated having had the opportunity to work in that state for several years. But one of the things of production that you've eliminated the risk is the irrigation pivots or the irrigation systems. And that's pretty well taken drought off the table in a big way. Let's move on down to the third one called financial. Any of you, I assume all of you've got a banker that you're getting real close and friendly with this year. But this is particularly stressful in the amount of working capital and what stress is on those budgets. And to manage your operation properly, you need cost and availability of capital and meet those cash flow needs and the ability to maintain and grow equity. And one of the things about farming is you can't sit on the sideline for one growing year. You got to be in it every year. And this is probably a year that most of you'd like to go and be set on a bench for a year, but it's not, you can't do it. It's not going to happen. The other one that comes up is legal issues. And that involves a big portion of farming is production and marketing contracts. The huge one is tort liability for that, like Dr. Walters talked about, that event that's infrequent but large. And those can be really astronomical. And then the stuff coming up with carbon index and those type of risks. The other one's human. And we all love dealing with people, and this is what this is all about. And taking care of your employee inventory, make sure that they have satisfaction and they have productivity that leads to a competitive position and strategy for your farming enterprise and business. And then strategic is the thread of farm's ability to meet long-run term strategy and objectives. And the big one we got going on right now is strategic, which I like to refer to as government risk. And we've got a lot of it coming in agriculture, and you need to manage this. But out of all that risk supply, let's go to the next slide, Cory. Excuse me, Dr. Walters for formal days.
Cory's fine.
Okay, here we are. The slide. This comes out of some work that Purdue's doing, and they're measuring the farmer attitude of each of these risk areas that were involved. And you can see that the two top ones are financial and marketing, because that's where that's what you're centered around, trying to make a profit this year. And then the other one that comes in is production, is right behind it, because in certain areas, certain things are happening. Like I understand in north central Iowa, the guy said he dug up a hole to put a deceased cow in, and it was nothing but sand down at the bottom of clay environments. But this is just a sort of a capture of how farmers are feeling about the risks threatening to their organization. Cory, let's go to the next slide, please. And when we talk, okay, so let's bring it down and focus on ensuring that crop you got out there, the production side of this equation, because we need the production to go along with the marketing to equal revenue and hopefully profit. Whenever I got involved in crop insurance back in the 70s, the only thing we had was a private product, which was hail, which covered wind, fire, storage, theft, vandalism, and those types of coverages. That's a private product offered totally by crop and hail insurance companies that provide crop hail coverage. Then in the 1980s, they moved from ad hoc disaster to the crop insurance program, and that has been one of the most terrific moves for agriculture, I think, in our lifetime, and your grandfathers before that. The types of policies I'd like to break that into is an indemnity measured individual loss. The adjuster, you've got a guarantee that's based upon your actual yield history. Losses are measured about what the grain comes out of your field. Those are revenue protection and yield protection. And then the revenue protections added to it, where it incorporated the market fluctuations into that yield product to make it a revenue based. That really is what Dr. Walters was talking about. If you find a price that you like before harvest, go on ahead and market that grain, because you're going to have crop insurance there to backstop that marketing position. And we find that, I don't know, the number sort of varies around, but last winter, whenever we switched over, there was probably about, depending on the area you're in, anywhere between 10 and 30% of the crop, 23 crop, that was priced and delivered. The next group of products that we are available to farmers is what I call the parametric, which is probably a new term to some of you. But what that amounts to, that is index that is linked to a reference measure or index of some type. The first one that RMA came out with was the county yield, where we were using the NASS data on county yield estimates, looking back 35 years to predict the current year. And if you had a shortfall over that county yield, it paid you. But that's indifferent from whether you had an individual loss or not an individual loss. So you need to, and we'll talk about this just a little bit. The other one's futures, where price is indexed off the futures market, which is different than the spot price you got in your own marketing area and marketing region. Another parametric is the rainfall parametric, being pasture rangeland and forage, and those type of policies where you're betting on the rainfall, historic rainfall, that this year, whether it's in excess or shortfall, and shortfall will trigger an indemnity loss. And the other ones you run into that are parametric are the margin protection, the ECO, SCO, area risk plan, and then the livestock family of products. And The question that I would give you on this when you're working with these and you're looking at them, make sure that the correlation between your farm and that index is as strong as you can find. If it's not strong, you're just your money to buy insurance, as Dr. Walters mentioned, may not match when you need the money. So the only thing I can do is just say, be careful when you do this. The agent that you're working with, have them produce the historic index by year so you can compare what your yields are and understand the variability in there. The other families, the non-reinsured supplementals, these are mainly developed and deployed and marketed by different crop insurance companies, and they are their own development filed with the state insurance department. And these are unsubsidized. And probably the biggest one you run into is replant expense. And then there's several others of price, incorporating price in a, product that you can buy, and different. There's numerous of them. So you got it's an alphabet soup out there of those. So work with your agent that knows what these are and can answer your questions, and make sure you ask a lot of questions and understand it. Because the worst thing you want is to get in and purchase one of these, and then all of a sudden later you find out it's not what you figured it was going to be. And then you're back into your legal risk because you're talking to a lawyer and you've got a claim that you didn't get paid. And the fourth option in this inventory of ways to manage risk is self-insurance. And Dr. Walters sort of talked about that, and we can talk about that when we talk about the federal programs. They always start with some coverage level. Well, the reciprocal of that is the deductible. So the least deductible you can have under the federal subsidized program is where it covers 85% coverage. So you got a 15% deductible of your APH that you're carrying the risk on that yourself. And then the other one I threw in there is nominal and effective spread. And what I mean by that is you calculate your APH, and RMA says your average that you can work with to start your insurance with is a 10-year historical of your production. So you buy 85% of that. So you're buying nominally 85% of your historic or 10-year APH. But if you're a good farmer and your average recently in recent years is starting to creep up a little bit, then you end up with an issue called effective coverage. And RMA sort of tackled that a little bit in their trend yield adjustment, where they'll add like 2 bushel an acre or something, like some figure like that. But you may, like one of the ones that we just analyzed recently in his county, he's got a 2 bushel trend yield adjustment. And historically, that individual is showing historic yields that's doing 4 bushel a year. So he's got that spread is getting wider on that one. So Dr. Waters, let's go to the next slide, please. So what I've done here is just run a sample just to show you how I sort of look at risk, and then deciding as we run all these factors together, how they interplay with each other. And I've chosen Phelps County, Nebraska, an irrigated practice with a 230 bushel APH. And I've run across the different coverage levels on an RP policy. And you can see as it goes across, like at 85% of that 230 bushel, you're only insured 195. So each one of those 5% increments adds 11.5 bushel to your guarantee. And I always like starting out at the 70% level because I think that's the best buy in revenue protection, because you get the most coverage. Let's just go down to row number 7. And if you look at that, the net premium per acre is $3.74 for 161 bushel or $750. That is a terrific buy because you're, and then your rate at that is probably somewhere around 1% of that. Well, let's see, it's 375, 370, about 0.5% is what it runs as far as a rate goes on that particular risk. And it gets back to what Dr. Walters was talking about. How much money are you willing to pay to transfer that risk to a third party, and what risk can you transfer? And so that's what, and 70% is where the maximum subsidies, and it's a best buy. And that was one of the starting levels that replaces the ad hoc disaster programs. And then in the far left corner down on 12 and 13, I did some calculations. Each 5% increment is worth 11.5 bushel. And that dollar amount comes out to roughly $54. So every time you buy a 5% increment above 70%, you're actually adding $54 of coverage to your dollar amount of protection. And just to show you how I look at it, let's go over to column L. And if we look at the where the highlight's at, and then you go over to the left side, it says rate online for $54. Let me explain. That's rate online is an insurance term. In other words, it's the rate of premium for the line amount of protection that you're buying. So in this case, you're buying between 80 and 85. You're buying $54 and you're going to pay $12.60 for it. Well, that premium to do that at the farmer subsidized rate's 23.6%. The way I look at it is that's a 1 in 4 bet. And the bet is that every 4 years you'll have a total loss. And I'm saying cost-wise and effectively using dollars, you need to sit down with your agent and your situation and decide whether that you want to pay 24% of the amount of protection to buy that coverage from your private insurance company, or you want to drop down to a lesser level. And then I'm back to my 70% level where it's cost you 2.1%. So that's just a way that I look at it, because I want to spend my premium dollars efficiently. So that's what I'm looking at. Let's go to the next slide, please.
That's all we have, Ken.
Oh, darn. I guess that's the end of my presentation. But I know some of this is probably causes some questions or whatever. So if we've got some questions, we got time for that then. So.
Do you have any concluding remarks? Do you have any concluding remarks?
This is going to be a year that, with tight margins, this is going to be a year when you need to understand your risk management plan, your risk strategy. And I know this is about crop insurance, but be aware of your whole total risk environment, because they all interplay with each other, and you're trying to get a profit out of this, and it's going to be difficult.
Need to survive this year to get to better profitable years in the future.
You can't set out this year. You got to play.
That's right. Excellent. We do have a few questions here, so I will let's jump into those, and I'll manage the questions. First question is, what about Great Northern beans? I'm not sure what you were looking for here. I would be happy to visit with you about them. If you're looking for insurance, or is there some positive chances of profit in that? I'm not sure. Our next question is ARC and PLC the same thing as crop insurance? Or are those things separate? In a way, the data generating process is very different for them, but they are free. There's no premium besides your time to sign up, and among some other costs around that, but you don't pay a premium. So they're in a way same, but highly differentiated because of the data generating process and the prices we're at today relative to where those things are at. There is a next question on thoughts on ARC or PLC in Nebraska. We could spend a lot of time in this, but what I'll get at though is the fundamental understanding of what is your base acres relative to your planted. And if that is really low, meaning few base relative to your planted, then the only insurance you will pick up is by going through PLC and then considering another county type program, such as SCO, ECO. If those base acres are pretty close to your planted, understand you still have a deduction in there because they're only going to pay on a % at your base. So understand your exposure there in those things, and of course the differential in prices. No, we are not covering anything today about winter wheat. Those contracts were already set last fall, but we'll be happy to talk about those winter wheat as we get into the summer. So if you're interested in that, please reach out to me. So that brings us to companion policies. I am not sure what you're thinking of there. Ken, do you have an idea?
I think I've got an idea.
Good.
Or at least we'll give them this answer. We'll offer this answer and hope that answers the question. And if not, we'll move on with it. Companion is a hybrid crop hail policy that has an accelerated payment factor. And the one that I see the most in the state of Nebraska is a ×4 factor. So the adjuster, if you got a hail damage to your crop, the adjuster goes out, measures the percent of damage, and let's say it's 5%. If you got a 4-factor companion, it'll turn that 5% loss into a 20% loss of the amount of liability you have. It was designed to wrap around the multi-peril policy to take up that deductible portion of about 30%. So it's got the accelerated payment factor, so where it totals out about 30 or 40% hail loss. And hail, let's talk about hail rates. And here's what I'll say about that. They are privately developed, filed with the state. Each company has their own rate. And the indications are from past history and the current environment of hail in Nebraska, you can expect increases in your crop hail premiums for this year over last year. As to how much depends upon your location, and that is by the plat map of what section you're in or what township, depending on to what degree of divisions they make that rate at. But it's based on historical cost of losses in that area. And the frequency of hail in Nebraska is increasing, and the severity is really huge. I saw some pictures of fields last year that there was nothing left but a stub out there in western Nebraska. That is horrible hail. So expect that. But it just takes a basic hail policy and accelerates the amount of damage as a factor so that it totals out somewhere around 55% or so. So that's what my knowledge is of a companion hail program, Cory.
Excellent, thank you. We got a question for you here, Ken. Does your Phelps County 70% coverage level change for maximizing subsidy dollars if you're comparing OU to EU? So optional to enterprise. I'm assuming your chart is relative to optional.
No, I'm using enterprise units.
Okay.
And this is a bias. Okay, the strategy in Nebraska is if you do enterprise units, basically what it says from my point is a risk management part of it. I want to make sure my farm makes a profit. I'm not looking at each individual field.
Correct.
And when you go from enterprise units, you're going to lose about 20 to 30% in subsidy. And then if you go from basic to optional units, it's going to cost you about 10% more in premium. So it's all weighed against one or the other. But what I'm sort of thinking of a farming operation that's got a large geographic dispersion about the county, let's go with an enterprise unit, save the money on the premium, and then we're just coming out with total dollars. Now, the converse strategy to that is with the high hail frequency, am I better off taking basic or optional for going the enterprise unit, going down to a basic or optional unit, paying more federal crop premium, but not having to make as heavy investment in the private crop hail? And again, that's a management decision. Those are two options. A, you can put it through the federal crop program and an enterprise unit by individual hail. B, you can reduce the unit size down to a basic or optional, smaller acreage, and pay the additional premium for that and lighten up your hail coverage. So that's just a personal decision that you've got to set out, and that's the reason we call it risk management. And the beautiful part about the involvement of all these programs together is there's a ton of choices And you got a tremendous job when you start working financially with what these options are. And, you sit down and say, well, I've got a lot of options, but thank God you got a lot of options. You can figure out what best suits your risk tolerance. But I just personally am of the opinion of, with farmers with large geographic spread is by the enterprise unit, by individual hail, and you can make that by farm location if you want to. So that's all I gotta say about that. Yeah, Dr. Walters, we didn't say much about the ECO and SCO. If we get time to make a comment on that. I can't hear you. Hello?
There, do you have me, Ryan?
There, you're
Am I
back.
on, Brian?
Yep.
Oh,
We're all
sorry
good
about
now.
that. It just turned off on me.
Okay. One of the comments, Dr. Walters, we talked about this is joining revenue protection as a base indemnity program and then putting a parametric of SCO or ECO on top of that to make a, some people are proposing saving premiums and that. Because you're using two different types of policies, you're never going to get a coordinated payment where both policies are going to pay at the same time. If you do, that's called a high correlation. If you don't, you're going to have some disparity in that. And if you're thinking about that type of strategy, just remember you've got two different setups as far as guarantees go, and then how the policies pay. And the concern in this year with the tight profit that you're looking at, trying to hit that bullet hole type thing. If you want to explore that, make sure that those two policies are as coordinated as you can get them based on historical data and work with your agent getting that analysis revealed for you. Because that's going to be very important this year.
Yeah, the question about if they paid out the way they're expected, or do they help manage risk? It's the first part is an empirical question. It'll be tough to answer right now. We need more years, but there's definitely been times where they have paid. I would caution anyone that just because you saw it or heard of an ECO, SEO payment last year does not mean that makes it a good policy, that you should buy it for the upcoming year or any time into the future. You need to look at at least a long run series of how that contract has performed, knowing that not everything is in that history, where there can be some other events in there that we have yet to see that could cause that to pay out more or less. And does it help manage measurable risk? Well, it is at the county for the yield. So it depends on how you're viewing measurable risk at the county and what practice you're in, irrigated or not. But at least you do pick up the price side straight across on that. So that can be fairly reasonable. And of course, what we don't know about these things is what data are they using to generate those expected yields, and how are those trends allocated to that to provide a reasonable expected yield in there.
Well, and I might add to that, earlier in your slide, you said be aware of your surroundings, and with these parametric county-wide yield policies, that's particularly true. In Missouri, there's a county called Atchison County, and I forget what the year was, but the Army Corps of Engineers released water out of a lake up north and flooded the plains area around the Missouri River. Well, that triggered a yield in Atchison County, and which that worked out great for the farmers in the plains area that had that risk and flood, so it wiped out their crop. But the ones on the high ground that took the policy got paid and they ended up producing a bumper crop. So I guess within that county that year with that event, you've got both extremes showing up at the same time. And that's what you got to be aware of what the makeup is of your county, because some of those counties in Nebraska are huge. And which gets a lot of variability in a geographic dispersion in there that may or may not make it work for your operation. And Dr. Walters, I know you've done some research on that. You might want to expand some comments on that.
I'll leave it as you hit the nail on the head when thinking about, your specific conditions and what does it mean when you add a county policy into it. You need to understand your risk around you, that you may end up with payments that you didn't foresee, or you did foresee it because you understood what Ken's example there said. It's this sort of slow thinking that you have to go through on these policies, because as an individual buying them, I want exposure to exactly what Ken just talked about. I want to know I'll get paid if something happens to someone else because I bought a county policy. I'd like to know that and understand how that works. But I also don't want to be in the side of I bought a county policy instead of as much of my own multi-peril because I thought that I was going to behave just like the county. That's very dangerous because something else may happen to you that didn't happen at the county, and you're out of luck on that case.
Exactly. Well said.
Any more questions? Not seeing any. We would like to thank you again for joining today's webinar. Look for the recording later this afternoon in the archive section of our Center for Ag Profitability webinar page, cap.unl.edu, webinars. When you exit Zoom, you should see a short survey, and we would really appreciate your quick feedback in today's webinar and ideas for other topics to cover in the future. Thank you again, and have a good afternoon.